Okay, so in this video, I'm going to be talking about option strategies for retirement income. So this is for you if you're approaching retirement, or maybe you're already in retirement and you want option strategies that are safer and at the same time, it's able to also consistently generate income for you. So I'm going to be sharing with you three option strategies over here, starting with the very first one. And that would be the income grid wheel strategy. So a number of you would most likely be very familiar with the wheel strategy already. But the income grid wheel strategy is a slight modification of it. And the main idea is to make it safer. So what exactly is this strategy? So instead of putting all your capital and selling your cash secured puts and covered calls at one strike price, you pretty much split it up into several levels or several tranches. So for example, what we have on the right hand side down here, this chart over here with the 5 cash secured put, this is the very traditional way of trading the wheel strategy. So let's just say, for example, you have decided that maybe, for this stock, you do not mind getting assigned at $19.50. So this is where you put your cash secured put at, and maybe the capital, which you have already allocated to this underlying, you can actually put on 5 cash secured put. So what most people do is that they just sell, whatever cash secured put that they can based on the capital that they allocate to this. So in this case, maybe it's 5 cash secured put. So the very traditional way of trading the wheel strategy is basically like this, right? So the market goes down. So let's just say it expires below your cash secured put. And this is where you get assigned and you get the 500 shares. And once the market goes back up again, right, the stock goes back up where you're able to sell the covered call, then you can sell the 5 covered calls as well. And if the market goes further up, you get called away. You restart the whole wheel strategy process again. So this is the traditional wheel strategy. But for the income grid wheel strategy, instead of selling all 5 cash secured put at just one strike price, what you want to do is that you split them up into different levels. So as you can see over here, the very first cash secured put will be at this level over here, which was based off of the first level when we sold the 5 cash secured put. But in this case, instead of going for all 5 at that level, we are going to split them up. So this is where you can have the second one over here, third one over here, fourth one, and fifth one as an example. Right? So as you can see over here, the prices where you want to decide these levels is really dependent on how far away you want the prices to get assigned at, because ultimately if the market does go down, then the idea is really to get assigned on this cash secured put so that you can start to sell the covered calls, and if the market goes up, you have your calls actually called away, then you're going to get capital gains on your positions as well. So let's say, for example, the market goes down here. So what you notice that with the income grid wheel strategy, you now are able to get assigned at even lower prices than the initial price. So previously, the initial price was $19.50, but because right now you have cash secured put all the way down at lower price levels, this is where you can get assigned as well. So first thing what you notice is that your average price is going to be lower than compared to if you had all your cash secured put at just one level, which is at the very top level. Then from here, you can start to sell the covered calls as long as it starts to go back up. So you sell them bit by bit. So you notice you can actually be selling this covered call as the market starts to move, rather than if you were to have the assigned shares and the market is still way below your assigned price. So for example, in the very first scenario down here, whereby you're assigned at this level, what you'll find is that it's going to be difficult for you to sell a covered call if the price has gone way down here. So all you're doing pretty much is just holding on to your shares, and you can't really sell any covered calls for you to get that premium. But if you trade the income grid wheel strategy, you can see that even though if the price is below the very first level, you're still able to sell the covered call as long as the market does go back and forth somewhere around the other levels. So this is where you can consistently generate the income. So why do we want to trade the income grid wheel strategy as opposed to the traditional wheel strategy for retirement income? Well, the last thing we want when we trade the wheel strategy is for the stock to go way below our cash secured put and we end up holding on to the stock for a long time. So this is actually what happened back in 2020 and as well as 2022. So for those of you who have traded back then, you would probably understand what I'm talking about, because those times, during those periods, I actually have quite a number of people who have reached out to me saying that, you know, a lot of their assigned prices right now is way above where the current price is. So they couldn't sell any covered call. So if you want to avoid that situation, then this is where the income grid wheel strategy can really help. So during this time when we hold on to the stock, we do not generate any income because we aren't able to sell any options. So as you can see over here, this is what happened to this particular stock. And again, it's going to be very difficult for you to sell any covered calls because the price is just going to be way below. And some people have even said, yes, they will sell the covered call maybe below the assigned price, and then they will just roll up the moment it goes up here. But the problem with this is that if the price all of a sudden jumps up too quickly, then it's going to be very difficult for you to roll this cover call up, and you're going to be stuck at a position whereby you're going to be likely called away at a price below your assigned price. So now instead of having a capital gain, you actually have a capital loss. So again, this is one of the situations that we definitely want to avoid. But with the income grid wheel strategy, you can still be selling the cash secured puts and the covered calls all the time, consistently, as long as it's within those levels which you have planned for you to generate income even if the stock goes down. Now, you also have a lower average price, which is something that I mentioned earlier, when assigned compared to having all your cash secured puts assigned at one level. So when your cash secured puts are staggered in this manner where you're always getting the lower prices assigned, then your overall average price is going to be lower as well. And this is going to make it easier for you to break even and even profit when the market goes up. So again, easier for you to get the capital gains this way. And lastly, and most importantly, this helps with your psychology much better, because when you have all your cash secured puts at one level with the traditional wheel strategy, what you find is that you're always hoping that the stock don't crash. In fact, a lot of the people, when they trade the wheel strategy, their mentality is that they do not want the market, the stock, to go below their cash secured put, because all they want is to just get the premium. Now, of course, this is something that everybody is desiring, right? But what if those times where the market has a very big move down, it goes below your cash secured put, then this is where you're going to be stuck. So when you trade the income grid wheel strategy, you're no longer like hoping that the market don't crash, because you actually do want the market to come down. You are looking forward to the stock going down, because if it doesn't, for example, let's just say it stays around here, then let's just say you get assigned 100 shares, then the market goes up, you sell your covered call. Guess what? You only are getting the profits on one of your position rather than all of the remaining positions. So you're not really fully utilizing your capital in this case. So when you're trading the income grid wheel strategy, we actually want the market to come down. So in this way, you're actually not dreading the market comes down, but rather you're actually welcoming it. So it's really a change in mindset, right? Especially when there's going to be a sudden spike down. For example, over the past few weeks and months, the tariffs hit and then the market started to have a very quick crash, and then after that it came back down. So if you had this income grid wheel strategy in place when that happens, you're going to be doing pretty well then. So how exactly do you trade the income grid wheel strategy? And I have already detailed this entire strategy in one of my videos already, which I call the Ultimate Wheel Strategy Training Program for Beginners. And this is a full course and it's free for you to watch it on YouTube. So just head on over to my channel and go and find this video, because this video will not only teach you on the traditional wheel strategy, but it will also teach you the income grid wheel strategy and also many different management that you can do when you're trading the wheel strategy. So definitely go and watch this video. I'll put the link at the top right hand corner as well, so you can click it and watch it at your own time. Next, option strategy number 2, and that is the bull put spread on SPY. And for this strategy, the bull put spread, we only specifically want to trade it on SPY, and I'll explain in a bit later why we want to do that. So first of all, what exactly is this strategy? So this is the bull put spread, also known as the put credit spread, and it's a very simple bullish option strategy where we generally want the price of the underlying to either go sideways, right, or up. So in this case, this is where we can actually profit from the bull put spread. So it's a very, very simple strategy. Now, the question is, why do we want to do it on SPY as a form of retirement income? And there are a few reasons for this. By the way, if you like this video so far, please subscribe and also click the thumbs up button. And also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Now, the very first reason is, first of all, in terms of put credit spread, the max loss is limited to the amount you decide to risk for the trade. And you cannot really lose more than that. So this long put down here is in place for you to protect in case of the market crashing. So although we're trading on SPY, the market can still crash as well. So when you have the long put, at least it limits your max loss just in case you're not able to monitor the market. So there are a number of people that have asked me before, Davis, can I just do the short put on it? Yes, you can, but you can actually lose a little bit more than what you may intend to actually risk for the trade if you are not able to monitor the trade pretty often. So that is why when you put this long put in place, then at least you're going to be able to rest much better at night knowing that, hey, the max loss is basically what you have decided as the risk for this trade. So that's number one. Now, the next reason, and the more important one, is that since the bull put spread is a bullish strategy, it only makes sense to trade it on an underlying that we know can go up over the long term. And one of the best underlying for this would be SPY, the S&P 500 Index ETF, which is a positive drift vehicle. So that is why we want to place it on SPY rather than on individual stocks. So for individual stocks, a lot of people like to trade it on that. And one of the main reasons really is because the premium tend to be much higher than when you trade on SPY, because SPY is not that volatile. But the problem with trading on individual stocks is that there can be a lot of news and it can be highly volatile. That's why the premium is higher, because you're taking more risk for the trade itself. And that also means that you can also encounter very huge gap downs, which is going to be way past your bull put spread. Now, of course, you already got it capped. Your max risk is capped. But we do not want to experience the max loss on the trade as well, right? So if we risk, let's say, $500 or $1,000 on the trade, ideally, we do not want to lose everything on that trade. So when you trade it on the individual stocks, that can actually happen. But when you trade it on SPY, it seldom happens because this is an index ETF. So even though any of the individual stocks inside the components of the S&P 500 is going to have a gap down, it's not going to greatly affect the SPY price itself, because there are just so many stocks in its holdings. So if you want something that's more predictable, more reliable, especially over the long term, then it makes sense to go with SPY. And as you can see over here, this is a study that's already done by the Tasty Trade team to prove that the bull put spread is going to be long-term net profitable. So if you're going to be trading for your retirement income, why do you want to put it on underlyings where you're not even certain whether it's going to be profitable over the long term? But with SPY, you already can see the studies have already shown that it's proven net profitable over the long term, even after all the crashes. You can see over here, this is 2008. 2008 is probably one of the biggest crashes that we had in history, which is the Great Financial Crisis. But as you can see, eventually you put on this trade on the bull put spread over the long term, you're still gonna become net profitable, even in the 2020 pandemic. Right, you can see over here the pandemic, there was a crash. While you of course would be losing some money during that period, as long as you continue to put on this trade over the long term, you're still going to be net profitable as well. Now, it also has a high win rate when you trade with SPY. You can see over here, this is another study that's done by the Tasty Trade team where they test the put spread of $5 Y and $10 Y, and they even examine two different types of exits. One is where you hold it all the way to expiration. The other one is where you exit a little bit earlier, which is 21 DTE. So as we can see in the previous graph over here, you can see that both of them, the performance over the long term is pretty similar. It's just that in the short term, let's say, for example, from the period around 2008, maybe to around 2016, you'll see that exiting at 21 DT is just going to do slightly better. But over the long term, it seems pretty much the same, but at least that's as of this data down here. But what's important is that this is overall a pretty high win rate strategy when you put on SPY, because most of the time, SPY is going up, right? It goes up more often than it goes down. But if you were to use this same put spread, but if you put it on individual stocks, then it all depends on the movement of the stocks. So if, for example, you put it on something like GameStop or AMC, then, good luck to you. Most likely you won't be getting this kind of win rate. So how exactly should you trade the bull put spread on SPY? So there are actually two different ways that you can do that. And I've already shared it in detail inside this video over here, where the title is Make a Living Trading This One Option Strategy. So definitely go over to my YouTube channel and look for this video as well. And I'll also put the link at the top right hand corner so you can watch it at your own time. Now, last but not least, option strategy number 3. This is the put broken wing butterfly. So far for option strategy number 1 and number 2, we generally have a pretty bullish kind of strategies where the income greed wheel strategy, we do want overall the stock or the underlying that you trade to go up. Similarly with SPY, we do want the market to go up in order for us to become net profitable over the long term. But for this strategy, going to be slightly different. And this is where we actually do not mind the market coming down in order for us to be profitable. But at the same time, if the market goes sideways and it goes up, we still can be in a profit as well. So this is why I really like the put broken wing butterfly a lot for retirement purposes. So first of all, exactly what is this strategy? So you can see over here on the right hand side, this is the construct of the put broken wing butterfly. Basically, it consists of a put credit spread that is financing a put debit spread, and it pretty much just shares the same short put strike. So it is a omnidirectional option strategy, and by that, what it means is that it can potentially profit regardless where the market goes, right? The market can go up, can go sideways, and even go down. You can still be in profit. But where it actually makes the most profit is when the market goes down, as long as it's not past the break-even point. So you can see over here, this line down here, I'm just going to draw a line to show you this is where the current market price is. So you can structure the put brokering butterfly whereby you have this max profit zone down here. So this is what I call the tent, because obviously it looks like a tent, whereby you want the market to actually come down in order for you to have a chance to be inside this tent for you to make more than the credit that you receive. So this green line over here, can you see over here? So we have the 0 line down here. So what it just means that anything above this point, you're just going to get the minimum credit that you sold this put broken wing butterfly for. But if you want to make more than this minimum credit that you receive, then the market would have to come inside this zone down here. So this is why it's considered a omnidirectional strategy and also helps with the mindset. So for example, if you're trading the put credit spread, for example, we generally want the market to go up. But if it comes down, then if you have the put broken wing butterfly on, you're not too afraid as well, because you do have this 10 down here in wait for the price to actually come down for you to hopefully capture profit for this. But of course, we do not want it to be too far down, because once it goes past this break-even point down here, once it goes past here, this is where you start to get into a loss. But of course, because this is a defined risk strategy, you can see over here, your max loss is capped. So in the event whereby the market really goes all the way down, very far past our break-even point, you do not have to worry too much as well, because you've already got your max loss cap, very similar to the put credit spread. So the idea down here is that when we construct this put brokering butterfly, we want to construct it around the expected move range, because most of the time the market will stay within this range. So as long as it does not go too far out within this range, we can actually be in a profit. So why the put broken wing butterfly? And there are a very important number of reasons for this. Now, first of all, it can have a very high win rate depending on how you construct it. So over here, you can see that the win rate for this particular structure is about 87%, but you can actually make it to about 90% and above as well. So it all comes down to how you actually shift the strikes to make it to a construct that you're comfortable with. Next, it can serve as a semi-hedge to bullish options position, especially if you have some long stock position. So if you are already in retirement, chances are that your portfolio probably do have some long stock positions. So if you already do have some long stock positions whereby you only can profit if the market keeps going up, then you definitely do want to put on some of this put broken wing butterfly as well, because in the short term, let's say for example the market does come down, then this one can actually potentially help you profit during those times, especially when your stocks are having a drawdown. So while your stocks are having a drawdown, the market comes down, this put broken wing butterfly can help you to capture some profits. Then in the long term, when the market goes back up again, those stocks which you hold, hopefully they are either the positive drift index ETF or maybe some fundamentally good stocks, then you're going to be profitable on them also over the long term. Now, another reason is that with the put brokering butterfly, you notice that you can have a better risk to reward ratio than other option selling strategies at the max profit point down here. Now, of course, it's going to be very difficult for us to get this max profit at this point down here, because you do need the price of the underlying to be right smack at this short strike down here in order for you to get the max profit. So it's not often that we're going to get it, but however, as long anything it's inside this zone down here, you're still going to get some profit still. So option selling strategies is pretty notorious for having, pretty bad risk to reward ratio, in a sense whereby we're probably risking maybe $4 or $3 just to make $1, or maybe $5 to make $1. But of course, the trade-off is the high win rate. So it's always a trade-off. But in this case, with the put brokering butterfly, you can potentially actually get pretty good risk to reward ratio. And as you can see over here, if we were to take a look at this particular structure, it's pretty close to about 1:1, maybe slightly less than 1:1, but you do have pretty high win rate as well. So with the put brokering butterfly, you can have a much better risk to reward ratio when it actually lands inside this max profit zone down here. Next, a very important one as well. It's psychologically much easier to trade than many other option strategy in the event the market tanks, because you actually want the market to go down in order for you to be inside this max profit zone. Whereas most of the option strategies out there, for example, the bullish or neutral one, like maybe the strangle, iron condor, or the bull put spread, all this, you do not want the market to move too much. But whereas for this put brokering butterfly, you actually do welcome the market coming down. So psychologically, it's going to help you as well. And again, it's also going to really be very helpful if you have a lot of long stock positions, like I mentioned earlier. And finally, which is the most important reason why we're putting on the put brokering butterfly in the first place, is because it's a very consistent income generator, mainly because we have a very high win rate. So these are the reasons why you want to put on the put brokering butterfly. So how exactly should you trade the put brokering butterfly? So similarly, I've also created a video where I go really in depth into how you construct the put brokering butterfly, how you trade it, how to manage it in this video over here. It's called the safest option strategies for beginners. So definitely do go and watch this on my channel as well. And I'll put the link at the top right hand corner. Alright, so these are the 3 option strategies that is going to be very useful for you if you're approaching retirement or already in retirement. So hopefully this video has been helpful for you, and if it has, I would really appreciate if you give me a thumbs up on this video and also subscribe to my channel for more options trading videos like this, and I will see you in the next video.